We're all here for one reason. I'm sure most of you will agree the world is changing at an exponential pace. We live in an era where borders become blurred and distances shrink, witnessing the global world transforming to a tightly knit global village, and what we knew to be true yesterday often no longer applies. This transformation brings with it more and more complexity, and sometimes even the experts need experts. Hi, I'm Higu Besaidenoot, and I'll be your host today. I know how important CPD points are, so please don't forget to fill in your ID number so we can issue your certificate. We also know life gets busy, and should you need to drop off, you're welcome to view the event on our events platform until the end of May. The sending of the CPD certificates is automated, and they will be mailed to you as soon as you watch the full session. Pop onto the speaker tab on the top menu bar if you want more info on the speakers, and you can also download the PDF presentations. Please also remember that you can engage with our speakers via the Q&A section, who will either answer your questions in real time or provide a response after the session. It's now time to hear from our experts. I'm handing things over to Ferdy van Heerden and Himne Landman, who will kick things off with an introduction.
Thank you, Higu. Good day, everyone. As the world has become a global village, it's crucial that we find a way to provide our clients with international solutions that cater to their diverse needs. We're here today for the 5th edition of the Momentum Wealth Global Citizen event to share insights on exactly that. I'm Himne Landman, CEO of Momentum Wealth, and I'm coming to you from our Centurion offices. And fitting to the global theme, I'm pleased to be joined today by Ferdy van Heerden, the CEO of Momentum Investments, who's joining me from our Momentum Global Investment offices in London. Good morning, Ferdy. How are you today?
Good morning, and thank you, Inda and Higu. I'm doing well, thanks. And London is having a good spring so far in March. But what a pleasure it is for me to join the conversation today. Welcome to each of you, our financial advisors, and the teams who are at the heart of making clients' financial dreams a reality with the financial advice that you provide. At Momentum Investments, we recognize the importance of financial advice, and as part of that, of course, a well-balanced, diversified portfolio, especially in today's interconnected world. Since the first Global Citizen event in 2023, these sessions have all been about equipping you, our financial advisors, with valuable information to assist you and your clients who require offshore investment solutions. And Himne, the year-on-year increase in participation at these webinars provides us with confidence that they are creating value and shows the importance of us collectively providing solutions for advisors to solve the client's global needs.
Certainly, Ferdy, and these conversations have become critical in this ever-evolving world. The investment world has really changed, and a lot of our clients are now dealing with dual tax residency. Some have kids living permanently abroad, whilst others are planning to move overseas in the long run. Naturally, this has made giving advice quite complex and challenging.
Yes, so as you know, I've had first-hand experience of having the opportunity to live and work in multiple places, including South Africa, Switzerland, and the UK, and with Portugal now maybe as a potential retirement destination. Navigating such jurisdictions effectively from a financial perspective requires careful planning, not least from a tax and inheritance perspective. This must be based on sound financial advice. Just last year, I spoke about the need for estate planning for global citizens, and I cannot believe how much has changed already around tax in the UK and Portugal since then.
Sure, Ferdy, given these changes, do you still intend to retire in Portugal?
Well, I'm not entirely sure what the future holds, but what I do know is that you need a financial plan that caters for a number of eventualities. And for that, I'm grateful that I have access to great advice. Having a trusted financial advisor with global experience is key to ensure I make the right decisions. Maybe a piece of key advice from me to others in similar positions as I am is that you need trusted specialist advice. and from advisors who work in sound, appropriate jurisdictions that align with your clients' needs, backed by established product providers and solutions that have proven their worth over time.
Thank you for sharing that, Ferdy. Financial advisors are indeed the backbone of this business, and they are instrumental in building and protecting clients' financial dreams. And we remain committed to enabling them to meet their global client needs. Today's event will address topics such as immigration, CITES tax, legislative developments, and changes in exchange control for trusts. And all of these insights will be provided by leading experts in the field.
Wow, Imne, that sounds like a fantastic lineup of speakers, and I hope we all enjoy it. And maybe the only thing from me is to say, strap in and enjoy the conference.
If that doesn't create food for thought, thank you for all the speakers for sharing such valuable insight. Thank you to all our guests today for your time, your participation, and engagement. An inspiration by Seneca, reminding each of you of the superpower that you hold. True wealth is achieved not by accumulating riches, but by mastering the art of financial wisdom and self-control, enabling one to thrive in a global world. And Momentum Wealth is here to support and enable you, providing solutions and advice along your journey to create and protect your clients' financial dreams. Thank you for choosing to spend your time with us today, and I look forward to seeing you at the next Global Citizen event. Have a great day and take care. Goodbye.
With an ever-increasing flow of funds out of South Africa and immigration of clients a real reality facing the local financial planning landscape, navigating these challenges are more important than ever. And joining me now on stage is Werner Kriel, Head of Advisory Services at Fin Global, who will discuss the immigration trends and the practical aspects that need to be considered when rendering advice to clients. But before we get into that, I just want to share some exciting news. Momentum is in the process of acquiring a majority stake in Fin Global from Bidvest. This means we'll soon have an in-house solution tailored for our global citizen clients. We're really thrilled about this development and can't wait to work together to serve you and your clients even better. Welcome, Werner.
Thank you.
Werner, maybe let's just kick off, and can you tell us a little bit about Fin Global, who you are, what you do?
Yes, Fin Global is a registered financial services provider. Like you rightly said, we are in the process of being acquired by the Momentum Group. We've been in existence for the past 15 years. We have helped successfully South African expats in more than 105 countries all over the world. We deal exclusively with South African expats, and we focus on tax and working with the red tape to make sure that assets can be liquidated and funds transferred abroad.
All right, so tell me, you've mentioned that you exclusively deal with South African expats. Tell me a little bit about what does that profile look like?
Yeah, we have three categories of clients that we deal with. First category, those planning on leaving South Africa. Second would be clients that have already left and have settled in abroad. And then the third category that's growing at the moment, South Africans looking to return to South Africa. So just the clients looking at leaving South Africa. At the moment, we see a lot of young professionals and also young families looking for opportunities for their children offshore. Those clients that have moved abroad quite some time ago, with the introduction of the expat tax regulations in 2021, those people are now contacting us to make sure that they are tax compliant. And then I think the same happens for the third category, people wanting to return to South Africa. They want to make sure that they are tax compliant before they buy that airplane ticket.
Okay, so tell me, when would you then typically get involved? Is it mostly when people already left, coming back at the start? When do you Fin Global get involved in the process?
Mostly we see that clients just up and leave the country, and then with all the changes in regulations, they now contact us after the fact. Luckily, one can cease your tax residency, for instance. You do that retrospectively. But then ideally, we'd like to get involved way in the beginning when a client contemplates moving abroad, because what we do is, as a company, we answer the what, the when, and the how. And we do that in-house. So we are in a symbiotic relationship with financial advisors, because they know that they've got one company to deal with, and we can provide them answers on a lot of different topics.
As you've pointed out, there's, a host of considerations when immigrating. What would you say has been some of the challenges you guys have faced in the process over time?
There are definitely 4 points that immediately comes to mind. I think the first one would be cash flow. Second one would be dealing with SARS from abroad. Thirdly, dealing with your local banks whilst you're abroad. And then fourth, just access to reliable financial information abroad. So when I look at cash flow, it's expensive for a person to move abroad. And that's something that you need to plan for ahead of time. And sadly, South Africans, they want to use the pension proceeds to fund their move abroad. And as they find out, some of these funds are restricted and they can't access it immediately. Just from a SARS perspective, I mean, it's different time zones. It's expensive to make international phone calls, and then you have call centers. You're holding on for hours to do that. So it's always easier just to get local representatives to deal with SARS on your behalf. The banks, same thing. They want you in a branch. They want to identify you there, and then they'll deal with you. Luckily, if you seize your tax residency, it clears up a lot of that problem for you. Banks are then willing to talk to you whilst you're abroad. And then the fourth thing, as I said, um, uh, you can't always believe everything that you read on Facebook, but it is good to link up with country-specific groups on social media, and generally speaking, they will point you in the right direction.
Sure. Yeah, I can't imagine trying to deal with SARS on the phone from
Yeah.
another country. But yeah, and also don't read everything or don't believe everything you read on Facebook. Eh? All right, Vanna. So we've covered some of the practical considerations and some of the challenges. Let's move on to some trends. Tell me, what are you guys seeing in the immigration trend space? Are clients still leaving as much as they used to? Are they coming back?
Yeah, a very good question, but also difficult to answer, simply because we don't have a lot of information regarding immigration trends. Latest information that's available to us indicates that there are more than 1 million South Africans living abroad. But we are seeing an increase in South Africans wanting to return to South Africa. Now, this could be geopolitical. It could be that the political landscape in South Africa has changed, but mostly we see that these are older people looking to retire in South Africa. It's still a relatively cheap country to retire in and still maintain a high standard of living.
Yeah, shocked. I don't know when last you went to Europe, but the price of beer made me long for home quickly. Eh? Um, Tell me a little bit about your experience with jurisdictions. Which ones are you often faced with more so than others?
Our clients mostly immigrate to the first world countries. So we're looking at the US, Europe, UK, Australia, New Zealand, Canada, those countries. Um, Interesting thing about those countries, some of them have some window periods in which, should a client move there, they can bring in funds into that country, or they can invest lump sum into pension funds at a zero or a very low rate of tax, which should be lower than what the average tax resident of those countries pay.
Okay, I mean, yeah, that's really interesting. I'm just wondering, when people immigrate, you're talking about flow of funds out there. How often do they actually leave assets here? Do they leave assets here, or do they typically take everything with them? And in doing so, what are the consequences of that?
No, again, a good question. Yes, South Africans do leave behind some assets in South Africa still. These could include pension funds, your bank account, property, shares in companies. Now, if you leave the country and you seize your tax residency, then that is a CGT trigger, capital gains trigger. And some of the assets that they leave behind might be taxable upon the ceasing of their tax residency, and that's normally based on the value of that asset as per the day just before they left. Now, post-immigration, after they cease their tax residency, if they then decide to sell an asset, then the double tax agreement will determine where that capital gains tax is payable. But when something like immovable property is sold post-immigration, then the conveyancer is obligated to withhold some tax, and then the double tax agreement between these two countries will determine who ultimately has taxing rights on that asset.
Sure, I heard a lot of tax there. It's just not getting away from that, eh?
Yeah.
Earlier you did mention or talk about the expat tax. Formerly it was known as formal immigration or financial immigration. Can you tell us a little bit about that change?
Yeah, no, for sure. Financial immigration was derived from the term formal immigration. And that came from 1967 when exchange control was enacted in South Africa. But since 2021, when tax immigration or tax exit was introduced, the old financial immigration was completely phased out. The tax immigration is basically you telling SARS that you're no longer living in South Africa. If you're successful with your application to them, they will issue a formal letter to you called a confirmation of tax non-residency status. That simply means that you no longer have to declare your worldwide assets and income to South Africa. And essentially, that same letter then also makes you a non-resident for exchange control purposes, which is the exact outcome of the old financial immigration process.
Help me quickly. Immigration is often a long and a protracted process. What can clients typically do to sort of prepare themselves for immigration, even though it might be, still a few years away for them?
Yeah. And immigration, I mean, it consists of so many parts. It's not only the physical immigration from South Africa. As we mentioned earlier, it's the tax migration from South Africa. It's the financial immigration from South Africa, moving your balance sheet abroad. Then you've got exchange control to deal with, and then the banking sector. So I would say typically a person should get in contact with a service provider that specializes in this field. As I said way in the beginning of this conversation, we deal with the how, the what, and the when, and you've got one company to ask these questions of and one company to deal with. And we help with a financial plan. We explain to the client when they should start looking at liquidating assets, and then also what they can park for when they arrive on the other side so that one can deal with it at that time.
Varun, you said you guys play an important role and can assist. Tell me, we often hear that there's this immigration has an impact on the financial advisor. They either lose their clients or a family. Is this inevitable, or does the financial advisor, can they still provide value for their clients once they leave?
Yeah. Sadly, I would say most of the clients that we deal with, they want a clear cut from South Africa. So they liquidate whatever they can, and then they move those funds abroad. It's just difficult to deal with two countries at the same time whilst you're trying to relocate and settle into a new country. But as I said before, we do have clients that leave assets remaining in South Africa, financial assets, and then also I would say um, products like risk products. And unfortunately, a financial advisor would play a limited role there because they can only advise in terms of the assets in South Africa, but they normally can't advise on products in different jurisdictions.
Varun, thank you so much for your insights today. But before I let you go, do you have any tips for us? For an advisor, client walks into the office and says, all right, we've decided we're leaving. Where do I start?
Yeah, I would say other than phone Global immediately, there are maybe 3 tips that I can leave them with. I think as a financial advisor, first thing is just establish to which country your client is looking at moving to. Because as I mentioned earlier, there are some window periods in which people can bring funds into their new countries at a lower tax rate. Number 2, establish what assets they will have remaining in their worldwide balance sheet on the date of their departure. As we mentioned earlier, there is a capital gains tax trigger on specific assets. And then thirdly, just establish once they've moved abroad, whether or not they're in a position to immediately cease their tax residency. That would be it.
Well, Werner, I thoroughly enjoyed today's chat. And, again, thank you for your time. And I wish you all the best for your travels back to Hermanus.
Brilliant. Thank you so
Thanks,
much.
Werner. Next, Amanda Moorman will give us a technical overview of Citus tax. Okay, let's talk about Citus tax. Yes, I know, not exactly riveting, but for South African investors with US assets, it's like that sneaky speeding ticket you didn't see coming. You think you've parked your wealth safely offshore, only to find out Uncle Sam has been waiting with a 40% estate tax fine just because your assets are sitting in his backyard. So buckle up, as Amanda Moorman, legal advisor at Momentum Distribution Services, provides a technical overview.
Thank you, Hugo. Good day, everyone. Today we will be touching on an important topic in cross-border investments, your tax considerations related to foreign investments, particularly the concept of Citus and other key tax principles. In today's presentation, we will cover an illustration of a South African tax resident investing in the US, the tax considerations of the investor whilst alive, upon death, and after death. And we will be closing off by considering whether Citus tax can merely be ignored. Looking at your SA tax resident with a US investment. So direct foreign investment is child's play. All you need is a smartphone and cash. Technology is bringing the world markets into the South African investor's home. Setting the scene. Here we have our client, Eve, who is a widow. She has one daughter as her heir, and she has invested $1 million in a US share portfolio. Looking at the tax during life. The South African tax system is based on residency. South African tax residents pay tax on their worldwide income, whilst non-residents pay tax on their SA-sourced income in South Africa. Many foreign jurisdictions follow similar rules, resulting in a South African tax resident potentially being liable for tax in the foreign country on the foreign income. This results in a risk of double taxation. It is important, therefore, to consult the double taxation agreement between South Africa and the foreign country, if there is one, and this will then determine which country has the right to tax. The US tax system is based on citizenship and residency. So a US citizen and resident will pay tax on their worldwide income, while a non-resident alien will pay tax on certain US-sourced income. Something to note in respect of double taxation agreements: if there is no risk of double taxation, the double taxation agreement will not apply. In cases where there will be double taxation, the double taxation agreement will provide relief. Your tax during the lifetime of investor. Looking at interest, from a US tax perspective, interest from bonds and bank deposits will be deemed not being from a US source for non-resident aliens. Therefore, interest will not be taxable in the US. From a South African tax perspective, interest will be included in gross income and will be fully taxable. So please note, your interest exemption will only apply to your South African sourced interest. Your double taxation agreement between the US and South Africa provides that interest will be taxable in the country of residence. As a result, interest will only be taxed in South Africa. Your dividends. From a US tax perspective, dividends paid to a non-resident alien will be subject to a withholding tax of 30%. From a South African tax perspective, your dividends is included in your gross income, and we have the exemption that will apply in the ratio of 25 to 45 for natural persons. Your double taxation agreement between South Africa and the US provides that dividends will be taxable in the country of residence. But the pay your country is also entitled to withhold tax. However, this will be limited to 15%. As a result, the US will limit dividend withholdings tax to 15%, and SARS will provide tax relief for the taxes paid in the US. Your tax relief is always limited to the lesser of the tax actually paid in the US or the tax payable in South Africa. South African dividend withholdings tax is taxed at 20%, so the tax to be paid in South Africa will not exceed 5%, to total 20%. Your rental income. From a US tax perspective, rental income earned from US property has a withholding tax of 30%. No deductions are allowed. From a South African tax perspective, your rental income will be included in your gross income and will be fully taxable. A deduction of expenses is generally allowed. Your double taxation agreement between the US and South Africa provides that your rental income will be taxable in the country where the property is situated. As a result, SARS will provide a tax credit or refund, which will be limited to the lesser of the amount actually paid in the US or the amount of tax payable in South Africa. Capital gains tax. From a US tax perspective, the US does have capital gains tax implications on certain assets held longer than 1 year. As a rule, however, no capital gains tax will be imposed on non-resident aliens. From a South African tax perspective, your capital gains will be included in gross income and will be taxable in line with your capital gains tax rules. Your double taxation agreement between South Africa and the US provides that capital gains will be taxable in the country of residence. As a result, capital gains will only be taxed in South Africa. So as a summary, your tax payable by Eve during your lifetime. Dividends, there will be a US dividends withholdings tax of 15%, and in South Africa, 20% less your tax paid in the US. On any interest in the US, there will be no tax. However, in South Africa, interest will be fully taxable. Your capital gains, in the US, no tax, but in South Africa, your normal capital gains tax implications applies. Going over to tax upon death. So as a quick recap, a person ordinarily resident in South Africa will be liable for estate tax on their worldwide assets. Certain foreign assets are, however, excluded. For example, assets acquired prior to becoming resident and assets inherited from a non-resident person as long as it has not been repatriated. A person not ordinarily resident in South Africa will be subject to CITES tax in South Africa on the assets situated in South Africa, and this will of course be subject to the double death duties agreement in place. Your estate duty is levied on the dutiable estates. All bequests to spouses is free from estate duty in South Africa. There's an estate duty abatement available of 3.5 million in a deceased estate and up to 7 million rand for the surviving spouse if there was a rollover from the first dying spouse's estate. Your estate duty is charged at 20% for an estate up to 30 million and 25% on an amount exceeding 30 million. From a US perspective, citizens and resident aliens will be subject to estate tax on worldwide assets, and for non-resident aliens, they will be subject to estate tax on certain assets situated in the US, and this is known as CITES tax. This, of course, is subject to your double death duties agreement between South Africa and the US. CITES assets included in the US tax net include your immovable property in the US, certain personal use items, shares of US corporates, unit trusts if issued by a domestic corporation. It does not include certain deposits in a US bank account and proceeds of life policies on the life of a non-resident who is not a US citizen, and also your collective investment schemes. The US applies a federal estate tax, and bequests by US citizens or residents to a US citizen spouse is free from federal tax. A non-resident alien has an exclusion of $60,000 on US CITES assets. So tax will be levied on a sliding scale of 18% to 40%. South Africa and the US have a double death duties agreement that applies between them. This agreement determines that the country where the asset is situated has the right to tax, and not the country where the person is domiciled or ordinarily resident. A tax credit is then awarded in the other country. The tax credit that will be applied will be equal to the lesser of the actual tax paid or the tax that would have been payable in the applicable country. The tax payable upon death, therefore, is, for capital gains tax purposes, in the US, there will not be any capital gains tax. In South Africa, death is a deemed disposal of a capital asset, and capital gains tax will apply to Eve's worldwide capital assets. Your South African estate duty implications: the value of the investment in Eve's deceased estate in South Africa is 18 million rand value, and we are assuming that this is the only asset in her estate. Based on the assumptions, the estate duty payable by her estate will be 2.9 million. Looking at the US federal tax, the value of the investment in the US, which is a US citus asset, is $1 million US, and the federal tax payable at the assumed maximum tax rate of 40% is $376,000 US. The double death duties agreement between South Africa and the US provides that the tax credits will be given in South Africa to the lesser of the South African tax paid, which is 2.9 million, or the US tax, which is 6.7 million. So, the US tax is still payable in the US. No estate duty will ever be payable in South Africa due to the tax credit that will be granted in South Africa. The red tape. The devil is in the detail. Foreign investors are required to obtain a tax identity number. They need to file a tax return to be eligible to claim double taxation relief. The IRS ensures tax compliance, as brokerage firms in the US are required to report to the IRS, and the brokerage firms are held responsible to withhold taxes. Global families require global planning. We need to look at the implications on South African resident beneficiaries and on foreign resident beneficiaries. It is important to plan for today with your eye on the future. A South African resident beneficiary is not required to repatriate their inheritance, but they have to declare and pay tax on any income and gains, and it will also form part of their estate. A foreign beneficiary will be bound by the laws of their country. It is therefore important to consider the asset type and structures, as certain countries impose tax on foreign trusts. Your investment types, like endowments, may also raise tax alarms in foreign countries, resulting in unintended double taxation. Ignoring citus tax. So you cannot ignore citus tax and the practical implications of holding assets in offshore jurisdictions. There is a worldwide compliance focus. South Africa has been in the spotlight due to the grey listing, and we have to adhere to the Common Reporting Standards and FATCA. The advice process. You cannot provide advice without referring to tax liabilities. We also need to consider the impact on the investment on your estate liquidity position. And it's very important to make a note in the record of advice. It is imperative, therefore, to consult with the necessary specialists. Citus tax is payable by the executor. An executor for a non-resident alien must file an estate tax return if the fair market value of the US citus asset is above $60,000 at time of death. If not paid, the citus tax liability remains as a lien over the assets, and the beneficiaries will remain liable. The IRS may collect any unpaid estate tax from any person receiving a distribution of property. The heir or beneficiary will therefore only receive the after-tax amount. Before releasing funds from an investment in the US for the purpose of selling shares or transferring ownership, the US may require that taxes owed, for example your dividends withholdings tax or estate taxes, be settled. This process ensures the US tax authorities collect taxes before funds are moved offshore. It is essential that the necessary planning and provision be put in place, and not only to focus on returns during the client's lifetime, but also to focus on the practical implications and the tax implications of the particular assets upon disposal and upon your client's death. Involve the necessary specialists and consider more effective and efficient structures. Thank you.
Joining me on stage now, to my immediate left, is Jeffrey Wiseman, Head of Momentum Trust Fiduciary Management, and to his left is Hannes Esterhuizen, a Regional Manager at Momentum Wealth International, who will take us through the practicalities facing the executor and beneficiaries when the SA client passes away. Hi guys, and welcome, and thanks for joining us. Jeff, I'm going to jump straight into it. And if you don't mind, can we just take a quick step back? Please, will you just describe the process if an executor becomes aware that a client has assets in the UK or the US or any other jurisdiction that might give rise to citus tax?
Well, the first thing is that we need to be told about the assets. So we're very heavily reliant on the family to give us that information. As soon as we know the details of the assets, we would typically contact a suitably qualified professional on the other side in the country where the assets are situated to ask for them to assist us in dealing with the taxes that might become payable as a result of them.
So, Jeff, what are the implications if the clients only have a South African will?
That's a situation that we deal with quite often. Many clients have a single South African will that deals with their worldwide estates, and we would use the authority given to us as executors to instruct our agents overseas, and they would then follow the processes that they need to in order to obtain the necessary authorization, and they would then attend to the payment on the taxes on our behalf.
Would there be any further implications should clients also have a will in a foreign jurisdiction?
Many clients do elect to deal with their assets in different jurisdictions through different wills, and in some instances it certainly makes sense. There may be assets in a jurisdiction which has a very different legal system to the one that we're used to here, and that would make a lot of sense. Some clients believe that having separate wills can speed up the administration process. The thing, though, is that from a tax point of view, South African estate duty is levied on the basis of residence, and so the executor here will have to account to SARS for all of the assets, no matter where they're situated and whether they're dealt with under a different will. And we would also need to know the details of the taxes paid to those other authorities because they will be relevant for calculating our own estate duty.
Okay.
Jeff, recently you had an experience with a citus tax scenario, client, the whole process of citus tax. I want to dig into that. Can you give us some background? What happened there? How did you become aware of the assets, the background to the client?
So this was a client, a high net worth individual who had a share portfolio listed on the New York Stock Exchange. It was managed by an investment manager and wealth manager here in South Africa. We were fortunate. The assets were well known and they were properly disclosed. And so when the estate was reported to us, we were given the details of the assets themselves and also of the wealth manager that we needed to contact in order to understand more details about them.
So, Jeff, you've dealt with foreign financial institutions. How easy or difficult is it to deal with these institutions?
That's actually a good question. In South Africa, when we deal with financial institutions, we would normally submit the details of the ID number of the deceased to the institutions, and they would cross-check their databases to establish whether there are any investments. When dealing with foreign institutions, it's not that easy, and so they will normally ask for specific details of the investment or the investment account that we're wanting information about before providing us with information. And so typically, if a person doesn't keep clear records or if family members are unaware of those details, it really can be quite tricky for us as executors to find out the details of the investments and where they're situated.
So in this particular instance, there were citus tax payable.
There was citus tax payable in this instance.
So
absolutely.
did you calculate that on your own, or?
No, we instructed a firm of lawyers in New York. They assisted with that process. They requested the information that they required in order to submit the returns to the IRS, and they then attended to it on our behalf. I think the assets were probably between $400,000 and $500,000, and the tax rate at the end was probably about 25%.
So, Jeff, tell me, How long did it take to wind this up, and what were the costs associated with doing it?
So dealing with the IRS with federal estate taxes is quite time consuming. So it's typical for a process of this nature to take up to 2 years. And so in this instance, it took about that long. And the professional fees that were payable for that assistance was about $7,500.
And that's in addition to the local executors' fees.
Absolutely, yes.
So not only were there additional taxes involved, there were additional expenses involved, correct?
That's right, yes.
How, in your opinion, how could all of this been avoided?
So the main issue there would be if it were possible, and I think it is possible, to invest in the same assets, but to use some kind of a wrapper where citus tax isn't payable. So, for example, an endowment contract or something similar through a tax-friendly jurisdiction such as Guernsey or one of the other Channel Islands. That could be a mechanism that could be used to avoid triggering citus tax on the death of the investor. In fact, the family advised us that this particular individual was speaking to his wealth manager about making that change just before he passed away, but unfortunately he didn't get around to doing it.
So planning to plan, and then the inevitable happened.
Exactly.
Well, Hannes, tell me from your perspective on a practical basis, how should advisors approach the topic of citus tax when they're doing financial planning for their clients?
Well, Ihu, I think it's a very important question. It's a question we cannot ignore. So we often get the question, how will these tax authorities know about the client? How will they know that he died? Now, I think the important thing is, and as we heard from Amanda, there's a whole range of mechanisms that will bring this out in the wash. In other words, that there's a person holding a share portfolio. So from a phase point of view, we also need to bear in mind that there's a duty of care in terms of the phase code of conduct, where you need to inform your client of these risks. So it's important to remember that it's your duty to look at citus tax. We must also bear in mind that, as Amanda also pointed out, the flow of information has improved drastically in the last 20 years. The Common Reporting Standards, the CRS, it sounds all very la-di-da and up there, but essentially it's the exchange of information on a daily, monthly basis between tax jurisdictions, between companies, between tax collectors, etc. So the flow of information means that lately, the past 2 decades, your information has become more available to offshore tax collectors. Common Reporting Standards is one example. FATCA is another one. So the US tax authorities are entering into intergovernmental agreements with tax collectors worldwide. And in terms of those agreements, they would exchange information, and those local tax collectors will also assist in collecting, for example, federal estate taxes. So by last count, I think there were 110 different intergovernmental agreements between US authorities and other countries. That's 110 plus countries where the information about clients are exchanged. And then, of course, the first point to make is that right now the information is not necessarily always matched. But with the rise of generative AI, analytical AI, I suppose that there will be some point in time where these databases will be matched, and where tax collectors will become familiar with the fact that you have a share portfolio in the US. So we cannot disregard citus tax. We need to look at it, and even if the citus tax implication is very small, expressed as a percentage of the estate, the cost in time can be very expensive. Jeff, I trust you'll agree with me. All of your specific case could have been handled much quicker if it weren't for the citus tax.
Absolutely. If you take a South African estate, we would typically target 9 to 12 months as a period within which to finalize an estate. Here, we are informed that it takes 2 years typically to sort out citus tax. If you haven't sorted out your citus tax, then you can't finalize your South African estate duty, because what you pay over there needs to be taken into consideration when determining your final liability. So certainly, if you can plan in a manner so as to avoid having to trigger citus tax on your death, I think the whole estate administration process will be made much easier.
Mm. And while all of this was going on, the heirs wanted to know, why is it not being finalized? Why is it not being finalized?
Exactly. I think one of the issues is that the financial institution won't release funds that are subject to potential citus tax until you provide them with proof of payment of the tax themselves. So if, for example, you have liquidity needs in the estate, those assets are essentially tied up until you can provide proof that the citus tax has in fact been paid.
Yeah. How did you actually pay that citus tax obligation in your case?
So in this particular case, there was enough money in the South African estate, and so we were provided with the details of the amount that was required. And of course, because it's a foreign exchange transaction, we had to submit that detail through to an authorized dealer, and they then had to give permission for those funds to be transferred to the United States.
So it was not only the cost of paying a law firm in New York, it was also the question of converting rands to foreign currency.
Absolutely, in this instance.
So a lot of additional
It did. It
expenses.
causes, it's definitely additional expenses, and it's certainly quite a lot of additional effort as well. And with that then comes extra time. So from a family's perspective, if the estate can be structured in a manner that you can
Totally avoid
eliminate
the
or
risk.
streamline the payment of these kinds of
Probability.
taxes, it really does serve them well.
Well, thanks, guys. I think, Hannes, you touched on it. I mean, the flow of information and information sharing is becoming more and more sophisticated, and it's imperative that it's disclosed, clients are aware of it, and the reporting is done. And, I think citus tax has been brushed off in the past, but it is really quite an important topic. So, Hannes, just in practical terms, how should financial advisors go about approaching this topic of citus tax?
Hugo, a very good question. It can be very overwhelming. So from my point of view, there's 3 questions you can ask. Question number 1 is to establish, is this client a tax resident in only one jurisdiction or in multiple jurisdictions? Now, for most clients, 9 out of 10, they would be South African taxpayers for our, let's call it, average client. But there are clients who are tax residents in both or in more than one jurisdiction. And that's where a professional service provider such as Global can come in and can assist in identifying the rules applicable to a specific tax jurisdiction, for example. So let's assume your client is a tax resident only in South Africa. So you've cleared the first hurdle. The second question is, does this client hold citus assets? Examples, fixed property in that jurisdiction. Jeff's example of a directly held share portfolio. There's a number of other possibilities as well, but those are the 2 most important ones in our universe. And once you've identified those citus assets, the third question would be, are there some fiscal or structural reason why citus tax is not applicable? That it might be that that specific amount falls below the minimums where theft duties, estate tax, whatever it's called in that jurisdiction, where it's exempted from because it's below that threshold. It might be because it's in a wrapper like an endowment. And that's your third question, to establish if there's some kind of structural reason why this is not subject to citus tax. But the fact remains that it remains a risk that you need to plan for, and it's not so difficult to solve for it. Ihu.
Thanks, Hannes. Yeah, that certainly gives us a lot to think about. I'd like to conclude here and say thanks, Jeff, Hannes, for joining us. So in short, CITES tax is a critical consideration for South African investors with offshore assets, particularly in jurisdictions like the US and UK. While offshore investments offer diversification and growth opportunities, they do come with complex tax implications that can significantly impact estate planning and wealth preservation. Thank you, Jeffrey and Hannes. It's now time for me to hand over the stage to our next speaker, Sharon, who's been patiently waiting in the wings, probably sipping on a coffee and wondering if we'll ever stop talking. Sharon Aman, a senior legal advisor at Momentum Distribution Services, will provide a legal update. Welcome, Sharon.
Thank you, Hugo, and good day, everybody. Today, I would like to share a high-level overview of some of the legislative developments I have come across taking place around the globe at the moment. Even though the Global Citizen Initiative is focused on the South African tax resident client, it is important to have a bird's-eye view on the legislative developments around the world, especially in some of those more prominent jurisdictions. In most cases, it will have no direct impact on your client or their financial plans. However, it can be relevant when considering clients with international estates and family structures. So, no surprises, we're going to start with the US. I'm sure that we are all a bit trumped out at the moment, and no matter on what side of the American political fence you're on, he is making waves. There are no major developments insofar it impacts the South African client at the moment, but it is worth mentioning that a potential tax overhaul is possible at the end of this year. There is a sunset date coming up at the end of the year on the current tax regime when the current income, gift and estate tax rates are set to expire. Inaction on the part of government will result in an increase in these rates. However, it is expected that President Trump will set a new sunset date and keep the rates lower. But, probably true to form, this is an opportunity for him to introduce new measures if he feels like it. So let's keep our eyes open. In keeping with the Trump trend, the US withdrew from the OECD agreement, which is the Organization for Economic Cooperating and Development, where the agreement is to implement a minimum corporate tax rate of 15% on certain qualifying multinational corporations. This is a worldwide initiative to curb BEPS, which is base erosion and profit shifting, which is effectively where multinational corporations structure their tax affairs in such a way to avoid paying tax in any country, effectively resulting in double non-taxation. Many countries around the world, including South Africa, is implementing this minimum corporate tax rate, but true to form, Donald is beating to his own drum. Let's go to the Netherlands. So we've got a lot of clients, especially kids, living in the Netherlands. The Netherlands are also introducing some tax changes. They are aligning with this move of double non-taxation or the movement against double non-taxation, where they are focusing on directors of foreign companies, providing that tax exemptions will only be applied if it was specifically agreed to in double taxation agreements, meaning that it will become a bit more difficult for them to get away with non-taxation. In the Netherlands, they tax based on 3 boxes. The first box being the employment income box, box 2 being income from businesses, and box 3 being worldwide investment income. Box 3 is up for a major overhaul in 2028. Currently, though, taxpayers are liable for tax on their worldwide investments based on a deemed return, insofar it exceeds an annual exemption. A notional return is then used, depending on the asset type, and then it's taxed at a rate of 36%. If the taxpayer can prove that the actual return was less than the deemed return, tax will be paid on that lower amount. At this stage, there's no clear indication of how this amendment will work, but we will have to wait and see. Now moving to the Mediterranean, we're going to Portugal. Now Portugal is quite active in trying to grow their tax residency base, and at the moment focusing on getting some of their immigrants back. And likewise, it is still a popular jurisdiction for South Africa due to the Golden Visa program that is still running. However, important to note that it no longer applies to real estate, but the minimum amount is still 500,000 euros for investment, and it must now be invested in either a Portuguese company, investment fund, research activities, artistic productions, job creation, anything that will bring about economic growth. Then possibly the one where we're going to see the most changes this year is the UK. I must remind you of the extensive tax changes that is being introduced, or that has actually just been introduced, because the new tax year just started on the 6th of April. The UK tax system is being changed from a domicile to a residency-based system, so it's huge. The old regime provided for tax relief to non-domiciled residents on foreign investment income and capital gains, as long as it was not remitted to the UK. This would typically have applied if a person did not live in the UK for more than 15 years during a 20-year period. If you exceeded the 15-year period, you would have become deemed domicile, which meant the benefit on the foreign income and gains would fall away. This all has changed. Where a person is a UK resident for at least 4 years, they will be liable for tax in the UK on their worldwide income and gains. So stating it differently, where a person moves to the UK on condition that they have not been in the UK as a resident for the last 10 years, they will enjoy a tax holiday on their foreign investment income and gains for the first 4 years, even if they remit it to the UK. After the 4-year period, it will become fully taxable in the UK. Moving towards inheritance tax, which is always very topical, it will also move from a domicile base to a residency base, and they're introducing a long-term resident definition, which is basically somebody who has been a resident in the UK for at least 10 years out of the previous 20 years. The long-term resident will be liable for inheritance tax on their worldwide assets. So for a non-resident, CITES tax will still apply, as explained by Amanda a bit earlier. If the long-term resident leaves the UK, they will still be liable for inheritance tax on their worldwide assets in the UK for up to 10 years after leaving. The number of years that this inheritance tax tail will apply depends on how long they were in the UK after the initial 10 years. So this will be quite relevant to those South African clients that have been living and working in the UK, and they are now contemplating coming back to South Africa. Just note, we do have a double death duty agreement with the UK, so the chances of double inheritance tax is slim, but some planning might be necessary. So moving away from inheritance tax to offshore trusts, if a long-term resident is a settler of an offshore trust, meaning they started the trust or they funded the trust assets transferred into that trust can be included in their estate for inheritance tax purposes. However, if they are not a long-term resident, the assets will remain protected even if the beneficiaries are long-term residents. If the settler of an offshore trust is a long-term resident, there is 2 taxing schemes that can apply, depending on the circumstances of the case. The relevant property regime is one which really entails the value of a trust asset being subject to tax at a rate of 6%, levied every 10 years, or when the assets are distributed to beneficiaries. If the settler ceases to be a long-term resident, so perhaps returning to South Africa, there will also be an exit charge of 6% that can apply. So it's quite harsh. If the settler ceases to be a long-term resident, like coming back to South Africa, there will also be an exit charge of 6% that applies. The second regime that we will look at is the gift with reservation of benefit rule, meaning that the settler is also a beneficiary of the offshore trust. And in this case, the assets will fall into the personal estate of that individual and be subject to inheritance tax of up to 40%. This can have far-reaching implications from an international estate planning point of view, where clients reside in the UK while still having their South African trusts intact. Moving away from the trust subject for now is another change being implemented, which is really looking at a person's unspent pension pot that remains upon death, which will be included in the dutable estate for inheritance tax purposes. So effectively bringing retirement funds on date of death into the inheritance tax net. So life insurance linked to retirement funds will also be included. So quite a big change. Just a reminder, inheritance tax in the UK is levied at 40% on assets as it exceeds £325,000, and these parameters are set to remain unchanged until 2030 when it will be reviewed. And also just remember, there's an exemption that applies for assets that are transferred between spouses, similar to what we have in South Africa. So if nothing else, the segment has once again shown that nothing stays the same, and it is an impossible task to remain up to date on a worldwide basis, and the devil will most always be in the detail. It is important to define our service offering to our clients and be clear that as a South African financial advisor, we are not authorized to provide financial advice in respect of financial products offered by foreign companies in foreign countries, and that we are not authorized to provide tax advice. Our role, when faced with foreign jurisdictions, is limited to finding the right specialist to partner with to assist us in making our clients' financial dreams and goals a reality. Thank you.
Thanks for that comprehensive overview of the ever-changing global tax landscape, Sharon. It's clear that staying informed and adaptable is key when navigating these complexities, especially for South African clients with international ties. Sharon will now facilitate a conversation on how to utilize an offshore trust as a means for local trusts to invest directly offshore. She will be joined for that discussion by Madeleine Schubert, an experienced attorney at Boshoff Inc. Attorneys, and Scott McPherson, Director of Trust and Corporate at Oak Group in Guernsey.
Hello everyone, and thanks for joining us for this impactful discussion. With me today are two highly skilled and qualified industry professionals, Madeleine and Scott. Thank you for joining us today. We will be chatting about local trusts externalizing funds to invest abroad. As you know, local trusts do not have a foreign capital allowance, and as a result, local trusts cannot invest directly abroad. Typically, they would use asset swap investments to gain international exposure, or alternatively, they will have to vest capital in a beneficiary or perhaps lend it to a beneficiary who will then use their capital allowance to invest abroad. Obviously flawed, as it will remove the investment or at least the growth from the protection afforded by the trust. So not ideal. But in August 2023, SARS made a statement on their website that changed all this. The statement will be in my downloads available on the platform. The statement effectively allows the South African trust to vest an amount in an offshore trust, thereby opening the door for the local trust to externalize funds abroad for investment purposes. Madeleine, from your side, perhaps just give us a bit of background. Why did this statement appear? And to be quite honest, I think the industry, or maybe I was just a bit slow. It took a while for us to catch on that this is something that we can do. So just maybe give us a background. Why do you think they made this statement to start off with?
Yeah, I mean, I don't really know why, but if you do speak to the people at Reserve Bank, which I did about 3 weeks ago, there is I've actually asked them, so when do they relax exchange control totally? And then they said they will never relax it for companies because they don't want a flood of capital. But they are at a stage where at some point they would probably relax foreign exchange controls for individuals. And maybe they do look at trust more in the form of an individual if there's a beneficial ownership of individuals there. So there is a tendency towards relaxation, but everything comes with a price, right? So this relief is wonderful because it can keep something out of the estate, but it does come with a higher tax cost. And so it is nice from a cash flow perspective, but of a higher tax cost. So you do pay in a way for it. Yeah.
Madeleine, was there any point to it of the change between this flow of capital being controlled by SARS and SARB being the two different guards to releasing the capital from trust? from my understanding in the industry, is when it moved from SARB to SARS to get SARS approval, SARS are looking at getting a higher revenue out of this. It's more cash now, not cash later, helps the fiscus of the country now. So that's, I think, maybe a bit of the background to releasing
Because
this.
of the tax cost, it's
Mm,
actually good. And of course, as we discussed before, and the industry is not consistent as well, is it keeps a tail as well, right? So when you distribute the funds from the local trust into the offshore trust, then there's different views, but we do feel it's a stronger view towards the one that whether the attribution rules keep on applying. In other words, where you pour over something from one entity to another and in the form of a donation, we have a tax avoidance rule that will keep us, South Africa, SARS specifically, entitled to go collect the income and the capital that arose from that pour over to bring it back to South Africa and keep it taxed in South Africa. Now, if that entity that did the donation, the local trust, obviously did the pour over, the attribution back would be quite high, hey? Because it's the marginal tax rate is 45% for income tax and 36% for capital gains tax.
I want you to hang on to that point because I want us to consider the tax when we look at perhaps
Later.
investment types that we can use within the
There,
foreign
of course, the
trust.
solutions.
Yeah, because it's an interesting one, and I think it will guide you towards certain types of investments at a later stage. Just from the SARS note, there's the requirements that you will have to meet is one, you obviously need an offshore trust as a beneficiary.
Yes.
It's not going to be sufficient that your trust deed states that the trustees can vest assets or funds or income in a beneficiary or a trust created for that beneficiary, either local or offshore. Am I correct to say that SARS would want to see the Piet Pompey's trust as a nominated beneficiary on the trust deed?
As far as the ones that I've dealt with to date, we've had to have the South African deeds amended to add the foreign trust as a beneficiary. So it's a proper named beneficiary appearing on the South African deed, and that comes with its own difficulties dealing with the Master's Office and a time frame to get those amendments done. So it's kind of the practical terms behind doing it. But yes, you, as far as I know, and the ones I've dealt with, has to be a named beneficiary. Madeleine, I don't know if your experience has been any different, if you've been
No.
able
In fact, that's how we advise most clients because you don't want to go argue now whether this offshore trust is a beneficiary or not. The standard trust deeds in South Africa always say any trust directly or indirectly. It's got that standard wording of a beneficiary wherever it's located. But I think for something like this, it's better it doesn't take a lot.
No.
It's a deed of amendment and you put the name of the trust there and there's no dispute.
Okay. So you will
better.
have the individual create the trust. Would the local trust be the settler of the foreign trust, assuming there wasn't the foreign trust, or would the individual sitting, your estate planner, be the settler?
It'll probably be the individual offshore.
So it's normally the individual offshore, but a nominal settlement of £100 or 100 USD to kick open the trust. There's a bit of a differentiation in the offshore market of the actual settler and the economic settler, which in South African terms is the founder. That economic settler would always be seen as the South African trust, which pours the capital in. But the actual settler, the founder in South African concepts, would have been the person who does that nominal settlement. That being said, in all legislation, kind of CRS reporting, FATCA reporting, any of those type of natures or overseas, we'll always see the economic settler as the main legitimate settler. So it's a bit of semantics.
No, but it's quite nice because in this case, if you had a offshore trust that's new and then the local trust with funding that for this pour over, then your economic settler would always be a South African trust.
Yes, yeah. So
which
actually,
is quite nice.
yeah, it would be an interesting one. And you can always declare it as a South African trust on the returns. And so,
Okay.
Yeah.
Just before we step away from the formation of the foreign trust, Scott, from your side, if you have to look at jurisdictions,
Yes.
where a client, what jurisdiction would they favor in which circumstances? Because
Yeah. So to be honest, I found kind of the offshore world at the moment, South African centric, is mainly your Channel Islands, with the Isle of Man as an extension of that, is very popular to the South African audience. However, it does come at a higher cost price, but at that higher cost price, they're seen as a kind of golden top benchmark jurisdictions to work with. Your cheaper jurisdictions are your ones like Mauritius and Seychelles, which are very African-centric at the moment, but still have their difficulties. Mauritius was on the grey list. It's come off the grey list now, but has never been put onto the equivalent jurisdiction list. So that limits some of your investment options from having a Mauritian structure. It limits some of the bank accounts you can use, where if you go more of the European, Sancho Channel Islands, Isle of Man structures, you get access to nearly any investment, you get access to nearly any bank accounts. It's much more first world finance sector you get access to. However, it is more highly regulated, and with South Africa being on the grey list, there are some shortcomings in that. So it really you look at the amount of capital that you're going to be sending out and see if the cost prices are way up the difference. It looks also at whether beneficiaries of that trust are going to be set up their lives, if they are going to remain in South Africa or Africa at large and always be African-centric. Most probably better using a Mauritian Seychelles structure. If you're looking at they're going to be going to university in the UK or the US or something of that nature, most probably your Channel Islands are a better option for you, but there's a slightly higher cost price to that.
Yeah.
As a rule of thumb, I normally say it's about double the cost to have a Channel Island structure to what you could get in Mauritius.
So what I sometimes recommend for clients, because South Africans, they don't like to pay any fees. So we often start off with Mauritius.
Yeah.
And then when the quantum and the trust is substantial enough that it does not become a pain to pay the fees anymore, you can easily change the trustees. It's a very easy process overseas as opposed to in South Africa. Overseas is literally just a contract that you do between the new trust and the old trust. It's called a DORA. And then you change jurisdictions by changing the trustees. So it's an easy process to manage.
So for a company like you that operate in all those jurisdictions, it's fairly
very
simple
easy. We can move matters between our offices. As Madeleine said, with the DORA, it's even not a hostile DORA where we're sending it to another provider. It's an oak presence to an oak presence. We can move it nearly overnight, quite a simple process.
Okay, that's nice.
That being said, if the clients are looking at that in the early stages of setting up, so as you mentioned earlier, one of the requirements from SARS is that you have the pre-existing trust set up. If you're going to be setting up a Mauritian structure, there's no reason why the proper law of the deed isn't Guernsey or Jersey. So the law that dictates the deed is already gold standard top level. Just the administration of the trust occurs in Mauritius. So you're getting the cheaper administration, but you're getting the strength of the proper law of the deed with the rich kind of precedent history of Jersey and Guernsey. To be honest, Jersey and Guernsey have been doing what they've been doing for the last 300 years. So the precedent bank of decisions on trusts are absolutely certain. We can nearly dictate exactly how things are going to flow out. Mauritius, on the other hand, doesn't have that rich history of precedents. And they have a French background. They've got a French civil code background to their legal structure. So if you're choosing Mauritius as a proper law of your trust deed, it comes with less certainty to what you're going to do. And it's less certainty than even other jurisdictions. We've got lots of clients in Singapore or Hong Kong, which still are British-centric. But because Mauritius is French-centric and civil law-centric, it gives those problematic elements. So simple answer, make your proper law Guernsey, Jersey structure, have it administered in Mauritius, and at a point in time when the trust is large enough and you need access to a more structured jurisdiction, you can, as Madeleine said, easily move the structure across.
Okay. So typically South African client today just wants to use it for investment purposes, use the Mauritian structure, but eventually when the kids maybe start immigrating, move it towards Guernsey when they start showing that they're interested in going to Europe or wherever.
That's exactly. Or if you're wanting to get more interesting investment options, wider array of investments, those type of things.
Just Madeleine, maybe from your experience, why is it so attractive? It can't just be because they want diversification. Why would you say people are using this structure to get funds out of the country? Because it doesn't come with, it's not a cheaper option if you compare it to asset swap.
Yeah.
Because the fees associated with the trust structure will nullify
balance
any
out, yeah.
benefit you can get on the product.
Not
So
sure.
is it related to immigration, future generational wealth planning? What would you say is
I
the
think
major
it's
trend?
traditionally South African trust, like you said in the beginning, we couldn't, South African trust, and still not sure why they've never amended that, can't invest directly offshore, right? So the only way for South Africans to have money offshore was to go the traditional foreign investment route, and then you didn't want to keep the assets in your own name, hence the foreign trust. So it's also then part of a international risk policy for high network families, actually for anyone, that you want physically to have cash or portion, if you can afford it, outside South Africa, and some money obviously in South Africa. So then, I mean, that is where a lot of the financial advisors obviously specialize in, because what's the split, the ideal split between offshore and locally? So I have clients that got all their money offshore, and as they need it in South Africa, they just bring back, because they often win with the exchange rate as well. And if they know if something does go wrong in South Africa, they can get on a plane and go out and the money is there. So, I mean, that is really the extreme cases. And then you have the more balanced, where you've got a 60-40 split, 60 offshore, 40 locally. So, but it then also depends on if you have a 40% locally, they want to use the local funds, keep the 60% offshore next generation.
Yeah.
So it's a unique question, but it's really risk protection for not having all your eggs in one country. And I don't think it's uniquely South Africa.
No, by
I mean, you were
not.
mentioning Turkey the other
Yeah.
day. It's the same. It's happening
same.
worldwide.
Yeah.
Yeah.
If I look at the statement, it says that they can vest an amount, or it sort of
Implies cash.
implies cash, yeah.
Yeah.
And do you think it only means cash, or do they actually allow assets
heard
to also
some-
go
yeah.
abroad?
My gut feel it's cash. I know any ones that I've been a party to has been cash. They've had
Yeah.
a liquidating event, pay all the CGT up front in the South African trust, get their all in cash and exit. I have heard in the industry that one or two people have tried it with actual capital assets. I'm unsure how that actually works out. I'm sure, Madeleine, you must have seen a lot more.
Same. I've only seen cash. Some of the other providers I worked with, they told me no, they've moved assets, but I still don't believe them, because it doesn't make sense. Because why would you strip the base through assets? Cash is easy because the thing that generates the cash might still be here,
Yeah.
or it's liquidated. So, but
So there's already been.
although some providers
yeah,
that
the
they've
CGT
managed
event,
to remit assets offshore, which I haven't personally seen. But again,
Yeah.
we hear say, but you know what?
Hear whispers around.
They
but
all-
yeah.
yeah, the industry is funny. Everybody wants to say that they've done something without, obviously you can't share because it's confidential. But I haven't seen in my own
Yeah,
eyes.
murmurs, yeah.
Okay. If you had to now do the application process,
Yes.
which you take clients through,
Yes.
what must you declare in that application? And is it to the Reserve Bank as well as to SARS, or only the one or the other? And also, how long is the time frame that it takes? So that if the advisors speak to the clients, they can just give them an indication of how long will it take, what information is really necessary, what can prevent approval from being given, and what is, obviously there's a bit of a cost implication because someone has to do the work.
Yes.
Correct. So two parts to this process. The first one, you start with the taxman. So on your download that you're going to share with the audience, there's a special email. So it's a manual application, and obviously they want to apply their mind to see whatever. If they're going to give approval, a SARSPIN, they need to see everything. So they're going to want to see the trust deed, they want to see the resolution, they want to see source of funds, and they want to see the trust is 100% clear. If they pick up something, you're in for a meal, because it might go into a full audit. So it's again, party line with SARS, 21 business days turnaround. But sometimes you get surprised if it's easy. I mean, in other words, if you have a local trust with shares in a local company and there was a declaration of a dividend,
Yeah.
I mean, that's cash in a bank, source of funds, dividend,
Simple,
20%. But yeah, it's easy. You'll probably find out will go quicker. If it's something more complex, like there was a sale of shares in the business and it was a difficult sale, then they're going to probably look at it and they're going to check the capital gains tax calculations, make sure that's right. Because once the money is gone, it's gone, right? So then I can't get it back. So then you're probably into for a longer period. So then it depends also the amount and of that transaction, because that will also, if it's a few million, obviously you're going to have a different, more senior auditor coming into play. So no fixed time period, party line 21 business day. Depends on the facts. Yeah.
And I think, Madeleine, as well as a pre-step to that as well, be mindful that setting up an offshore structure also takes quite a bit of time. So you need to first get your trust in place, as we mentioned earlier. You have to get your South African trust deed up to spec, so do all the amendments on the South African deed. You have to open up the foreign trust, which takes, in my mind, about 3 months to get open at the moment, mainly from the amount of due diligence that has to occur on South Africans at the moment. Because South African being on the grey list, it means that there's a heightened, enhanced due diligence has to happen on all clients setting up an offshore structure by the offshore regulator. So be it the Mauritian Financial Services Commission or the Guernsey or Jersey Financial Services Commission. They are holding trustees to account now quite strictly on those enhanced measures. So when you're opening up a structure, one of the big things at the moment is source of wealth, source of funds. Even if those funds aren't actually going to go into the structure, it's a story of wealth of the client, and they want documentary evidence for some of those wealth. So I've got clients who have inherited money. We have to go and dig out the old estate accounts from the master's office to prove inheritance on estate accounts. So
amazing.
Things of that nature. Sales contracts, if you've sold businesses.
Yeah.
I've got a client who sold a business in the 1950s.
So you
We
go
can't find it.
much more extensive than South African audience.
Yes, much.
So in South Africa, you just source of funds. It's really, I sold my business. That's it. You go, sold my business, but
Where's the evidence?
where did you get evidence to buy the business?
How did you build the business? Where did it come from?
Okay, so they can do a lot for timing.
Will process.
And the bank account, of course, that's harder.
So
Yeah.
once the trustee has all of that information, we normally try and get as much as we possibly can and detail that journey to wealth, is what we call it, quite deeply. So when you open up a bank account, when you open up an investment account, we have that information ready to provide quite quickly. We do hit scenarios where we try and open up a bank account and they ask for even more information than we have. So it's a drawn-out process.
I did put a little picture together for our audience just so that they can have a look at the process that you will go through. So you've got the local trust that has to create the offshore trust. They have to amend the local trust. This will also be on our platform, but obtain the approval. Once the approval has been received, then you will have a flow of funds, and only then can the investment take place. So that can take a couple of months. And I've also highlighted where the potential cost implications are. So this is something that you can use for the audience, that if they're speaking to their clients, they can show them this is the process that they really have to wait for. And that's going to happen. Just on the investments, the types of investments that you would see in the trust. We just have to discuss that in a little bit of detail because I think it does impact our decision making, and also when talking to the client, what can they do with the money once it lands in the trust and what is the most ideal thing. And Madeleine, as you alluded to earlier, we do have the potential threat that once the money has not gone into the offshore trust, SARS might see it that it comes back to the local trust because of our deeming provisions and attribution rules. So does that necessitate us to consider investments that might prevent that from happening?
Correct. So you want to then you don't want to go fight something, you don't want to manage a risk with an unknown risk, whether SARS will trigger it or not, we don't know. But if I was SARS, of course I will invoke it. So then from an offshore investment side, you would want to create what we call a legal blocker from a South African perspective. And that's where your things like endowment policies do really make sense, because once the money lands in an offshore trust, it's seen as trust capital, which is great. So that initial capital itself is not taxable. But it's anything that you then do with the money that you invest, the growth. So if you then now take the growth and you rather put it in an endowment wrapper in an offshore trust, then even the growth, obviously it's taxed in the policy. There's no attribution that can happen because it's locked out.
It's a different taxpayer.
It's a different taxpayer, but it's within that fold of the trust. And any money that comes out, whether it's the regional capital or the subsequent growth portion of that, will remain tax-free in a South African beneficiary's hands if you had to bring it back.
Okay.
And it always at a lower rate as well. So that would be ideal solution.
Yeah.
Okay.
Very elegant solution, yeah.
Yeah.
Other positive for that, Scott, is possibly your administrative requirements if assets are sitting in a
Nice
live
little
wrapper.
separate wrapper. So you understand offshore trusts mainly charge on a billable hour basis, similar to lawyers or accountants. The less work that has to be done, the lower your trustee fees will be. So if your assets are sitting in a nice little portfolio, in a nice little endowment separate from, in essence, the trust administration that requires actual admin work to be running on them, your fees will be a bit cheaper. So it's a win-win, I guess.
Okay. So not to say the other investment options are not good, but we have to consider potential tax consequences towards costing, and then obviously taking into account what clients also like, because some of them have got their own ideas of what they want to do.
No, of course.
So I think we have to wrap it up. I think we're running out of time because this is a topic that we can discuss at length. But in closing, I would just like to confirm that this is not necessarily a solution that will suit all clients, obviously. And we have to look at the cost versus the benefit. As you could see on the little chart that I put together, there's a lot of steps and moving parts, and most of them are associated with costs. And as Madeleine said, clients in South Africa and probably worldwide do not enjoy paying costs if they don't have to. So it is a costly exercise to do, and there must definitely be a bigger picture than just getting money abroad, I think. However, where you are faced with a client that wants to explore this option, please reach out to either your NWI consultant or a legal advisor in your region, as they can involve all the parties necessary to bring this plan to life if it's deemed viable for your client. Thank you, Madeleine and Scott. I do appreciate being here and your time. And hopefully we'll chat again soon.
Oh, thanks.
Thank
Maya.
you.
Thank you.
Cheers.
As we wrap up today's discussions, I'm now joined by Marius Celia, a regional manager at Momentum Wealth International, who is stepping in to help us tie everything together. So Marius, welcome. And I'm sure you would agree today has been a lot to digest there. There's been a lot of information. But what I'm looking to do here is just to help us tie it all together and maybe leave our audience with some golden nuggets for future discussions with their clients when advising on offshore investments. So tell me, in your view, what is the approach an advisor should follow when selecting which platform or which structures they should use when advising clients on offshore investment?
Sure, you're right. I mean, there was a lot of information today. And if you followed our previous series on Global Citizen, also a lot of information. I think the structures are very important. And the structures are important because it sort of addresses the client's specific needs. And the structure drives the outcomes for what the client is looking for. When I talk about structure, I'm referring to an investment platform, because you need an investment platform with choice. You need an investment platform with a lot of investment components, but you need to back that up with boots on the ground in terms of support, because there's a lot of support needed in terms of putting these structures together for meeting a client's specific needs.
Okay, well, you mentioned there's, obviously variety of products available. You've mentioned a few things that you need to look out for in choosing that. How does Momentum International really cover those needs?
Okay, so let's start maybe with Werner. After today's discussion with Werner, I think there's a new value proposition from a Momentum's side in terms of immigration. But once you've covered that box, I think you need to look at the platform. And when you look at Momentum Wealth International, domiciled in Guernsey, we of course know that we have the international list product. We have both variations of the endowment. We've got so much investment component choice for a financial advisor and a client to choose from. But I think an extension of that now is also, for example, Sharon's legal BDM team that can assist with structuring and some tax advice. Madeleine from an offshore and cross-jurisdiction tax planning point of view. You have us in terms of the Momentum Wealth International regional managers. And then, of course, you have MDS and the investment consultants. So I think Momentum's offshore value proposition is very comprehensive. And we're really there to assist and try implement tailor-made financial plans for financial advisors.
So, yeah, that really is a comprehensive offering, and it does seem to cover most bases. Moving on to the Citus tax conversation. There was a lot said about it today. What is the importance of bearing it in mind during the financial planning process, and what did you make of the overall discussion?
So, in my experience, the Citus tax conversation is sometimes a conversation that's don't worry about Citus tax. I've never had a client that had to pay Citus tax, sort of brushed aside. But I think after the Citus tax conversation today, I think financial advisors will ignore it at their peril. I think I don't really understand sometimes where the resistance to the endowment comes from, because the endowment doesn't only cover the Citus tax or negate Citus tax. There's a lot of other benefits, an endowment brings to the party. A few examples of that is, of course, there's no executors fees. If you, in our life insurance bond endowment product, after 3 years, you're protected from creditors. And also the succession plan you can put in place with an endowment, that transition between ownership is also free of capital gains tax. So we tend to focus on the endowment just from a Citus tax point of view and the benefit it brings there. But I think there's so many other benefits an endowment brings to a client that should be taken into consideration.
Yeah, I mean, I think, you've made a few important points, in how you can structure to avoid Citus tax, but really there's plenty of benefits that should be taken into account in utilizing the endowment. I'd like to wrap up with one last question. For you, what were the main takeaways for advisors from the trust discussion that Sharon, Madeleine, and Scott had?
Yeah, it was a very interesting one. I think the first point I want to just reiterate again is that trusts don't have an offshore allowance like individuals do. As an individual, we've got the 1 million rand discretionary allowance and the 10 million rand offshore allowance, but a trust doesn't have that. So trust usually, in order to get offshore exposure to international markets, either have to do it through a local platform where they invest into feeder funds, for example, or they use an FSP or a local platform's asset swap capacity in order to get exposure to these international components. But for them, it's always a rand investment in and a rand investment out. What Madeleine and Sharon was talking about is setting up an offshore trust, and then the local trust, basically with the necessary approvals from the authorities, distributing from the local trust to the international trust. That international trust then obviously sits with hard currency that they need to invest. And that's where Momentum Wealth International comes in, because once again, you can implement that investment either through the international investment option or the international endowment option. Now, from that discussion, we can maybe conclude that the endowment in most situations will be the choice product. But once again, in all financial planning considerations, it's about what the client's trying to achieve, what their situation is, and that's where you can rope in the specialists. Get the specialists in, look at the client's situation, and choose the best product that will suit the client.
Well, it certainly is beneficial that we've got all the options. So Marius, listen, thank you so much for your time today and for concluding the session. And that brings us to the close of today's conversations. I would like to thank each of our speakers for their contributions to the discussions, and also to you, our valued partners, for joining us today. I trust that we've left you with more clarity and confidence to provide your clients with the necessary advice to help build and protect their financial dreams. Lastly, please remember that Momentum Wealth International provides you with access to a team of experts to assist you with all aspects of offshore investing, from structuring to navigating cross-border tax considerations, ensuring you're fully equipped to meet your clients' needs. I look forward to continuing this discussion in future.